Ladies and gentlemen, good day, and welcome to the S. Chand & Company Q4 FY26 investor conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to the senior management of S. Chand for the opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, ladies and gentlemen. I am Himanshu Gupta, the Managing Director of S. Chand Company Limited. I would like to welcome you all to our fourth quarter and full year results conference call for FY26. And thank you all for taking the time out and joining us here today. The FY26 sales season was an excellent season with strong volume growth and with old and new syllabus books being adopted in schools for the new academic year. Looking ahead, we are quite optimistic for FY27 since the new syllabus books for K8 are already released and CBSE released a circular in April 2026, stating that the new syllabus for classes 9, 10, 11 and 12 will be launched during the next few months. On back of this development, we expect the FY27-28 to see complete adoption of the new syllabus books for the K-12 segment, which should strongly support our growth trajectory over the next 2 years. On the AI dataset content licensing revenues, we had a great year with over 60% YOY revenue growth during FY26. We believe that this revenue stream has a huge potential to grow and deliver for our group in the coming years. Saurabh will give you more details on this in his remarks. Curriculum sales adoption grew faster for all the new Milestone, MyZen, SmartK and Solid Steps being adopted in over 1,500 schools. On the higher education front, test prep partnership with YouTubers along with government and options for Panchayat was also in focus. Our multiple partnerships for content and licensing, including Allied for ICSE books, Penguin for English readers, Jump Maths, Discovery, Money Prep for financial literacy, Speed Labs for JEE and NEET Foundation, and many more held us in good stead for enhancing our sales momentum and diversifying our portfolio. We have completed our first international acquisition in January 2026 when we acquired CPD Singapore, which gives us curriculum capabilities for the India and Asia market. CPD Singapore is a publisher of supplementary books adhering to the Singapore IGCSE, which is A-level, O-level, and also IB curriculum for K-12 school segment. This fills in our gap in our product portfolio and makes us future ready for this fast-growing segment, which has over 1,000 schools in India. Overall, IGCSE has over 4,000 schools around the world, with largest concentration in Middle East and South Asia with over 1,000 schools. The number of IB schools world over is in excess of 6,000, the large number being in South Asia, Australia and New Zealand. We believe that this has the potential to be a USD around $8 to $10 million business in the next 2 years. We are proud to say that we continue to be debt-free company at the end of FY26 through consistent efforts on working capital management. Our strategic partnerships and collaborations have allowed us to expand our offerings and meet the changing needs of our customers. Our commitment is to continue this positive trend and enhance our financial position over the long term. With that, I would now request our Group CFO, Mr. Saurabh Mittal, to apprise us of all of the financial performance of this year. Thank you.
Thank you. Good morning, everyone. I am Saurabh Mittal, Group CFO of S. Chand Company. I would like to welcome you all to the fourth quarter and full year results conference call for FY26, and thank you for taking the time out to be here today. I'm extremely happy to share the FY26 has been another strong year for S. Chand Group on many parameters. I would like to highlight the following key points for the year gone by. The company achieved revenue in line with our guidance of 8,000 million. We sustained a high gross margin level of 68% this year, despite the 6% GST hike in paper and on the back of a better product mix. So we achieved the highest EBITDA of 1449 million and EBITDA margin percentage of 18.1 million, which meets the guidance of 18 to 20%. We achieved operating income of 861 million, which speaks volumes of our operating efficiency. We achieved profit growth of 21% and ended the year with a PAT of 731 million. The company continues to build on its net debt-free status at the end of FY26 with a cash balance of 1048 million, despite a capex of 362 million and acquisition outgo of 107 million. It gives us ample headway to look at potential M&A and/or buyback from internal accruals as well. We continue to deliver solid working capital metrics, and we have announced an interim dividend of 4 rupees. All this has resulted in generation of strong operating cash flow of 747 million for FY26. We have proposed an interim dividend of 4 and remain net debt-free at the end of the year. In terms of working capital, our trade receivable increased to 3,503 million from 2,753 million. This increase was driven by shifting of certain receivables from Q4 to Q1 in the digital business. The war in the Middle East has impacted collection from schools in that region. The metrics will normalize within the first half of this year. In terms of receivable days, it stood at 160 days versus 140 days in the quarter last year. Inventory increased to 1,634 million versus 1,401 million. This inventory increase is driven by the slightly higher finished goods inventory due to the NCF rollout. In terms of inventory days, it stood at 232 days versus 223 days. With the NCF implementation settling in, we expect the largest improvement in this metric in the coming year. On the back of these movements, net working capital increased to 164 days versus 151 days. In terms of cash flow, all this resulted in generating of operating cash flow of 747 million for FY26. Our FY26 operating cash flow could have been higher had it not been for increase in receivables due to the shift of content licensing revenues of 165 million from Q4 to Q1. Minor increase in receivables due to delay in the collections from the Middle East due to the ongoing conflict. Minor increase in inventory due to the NCF rollout. We expect receivables and inventory to normalize during the first half of FY27. Do keep in mind that we have delivered an average OCF of approximately 1,000 million over past 5 years. We expect to deliver the OCF of over 1,000 for FY27 also. As we go into FY27, I would like to target the following. Firstly, we are looking to grow operating revenues by 10 to 15% for the year. Secondly, we are giving an EBITDA and guidance of 17 to 19%. This guidance is lower than last year on the back of increased cost due to the escalation of prices of paper, logistics, transportation, packaging due to the currency depreciation and higher fuel prices in the current year. Thirdly, we look forward to continuing our focus on working capital metrics and cash flows. Fourthly, we are open to evaluate M&A opportunities which fills in the gap in our portfolio. We aim to leverage our group strength in such acquisitions to deliver superior value to our customers and stakeholders. Fifth, we are looking to target revenues in excess of 400 million in the content licensing opportunities of text, images, and videos, and grow the number of clients. We remain focused on building long-term value for all our stakeholders, and we believe that our unwavering commitment towards operational excellence and delivering value to our customers will continue to drive our success in the coming years. With this, I would like to open the call for questions. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Nitin Dharmawat with Aurum Capital. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yeah. Yes, you are.
Yes. Yeah. So, I wanted to understand first is what is the situation of implementation of NCF now, considering that the rollout has increased, as we understand from the media reports. So can you please elaborate that and how it is going to help us in terms of revenue and spread in the market?
Saurabh, are you answering that? Yeah. Good.
Yes, sir. Up, please.
Sorry. Yeah. So NCF rollout it would be completed. We hope that this year that exercise should be completed, and the full implementation will start this year or maybe early next year. That is what we have from the market. And we believe that the advantages will definitely come to the company in that regard. And we have all the products in the portfolio is fully ready. And NCRT and all have already announced their books, the rest of the books which were not out. So, but this year end, I think all the products from the government, NCRT, will also be out. So the NCF should be complete this year, or maximum, I would say, the year after.
So this revenue guidance of 10 to 15% does not include any upside because of NCF implementation?
No, we have already seen 10 to 15% is a good guidance because it's not a small number. It's a big number, and we already grown, like this year, we have grown by around 11%. So these advantages are already, we are taking care of, and this year also we should get 10 to 15% growth. So it's a decent growth on a large base. We have to understand our base is quite large in terms of other publishing business. Because their base is smaller, our base is quite large. So I would say 10 to 15% is a good growth rate.
Yeah. Okay. So my next question is, you mentioned that the license for this content license for AI has a potential to become big. However, it continues to be one-time or ongoing yearly payment. If one-time payment, then how it is likely to become big? Because last year we did, this year we did around 40 crores, and prior to that we did 32 crores. Or we have given a target of 40 crores, and this year we did 32 crores, and prior to that we did 20 crores. So how big is the potential, and considering the fact that it is one-time or yearly payment?
Yeah. So I think, see, it's a mix of one time, it's a mix of, so I mean, various clients have different requirements. So some of them are doing 2 years renewal, somebody is doing annual renewal, and some of them are one time. But even in one time, they're not taking the entire content of our repository. So they are only taking, let's say, 10-15% of our content. So we still have a lot of potential in the next few years. And and the first year we had probably 2 clients. Last year we had about 5. This year we are picking up 2 more clients. So the number of people working on these LLMs are increasing by the day, and we've also started outreach to more clients. So hopefully we're trying to build this into a larger business.
So big means how big? 40 crores to 100 crores, 200 crore, what kind of potential is there? And split between, fixed payment versus annuity. So if you can elaborate that as well. As per current status, and where do you see in 3 years, 5 years timeline?
So as per last year, I think we did about 30% was term and 70% was period license, right? Some of them were 3 years, some of them were 5 years, some were 2 years, one of them was 14 months. So term is 70%, 30% is one time. That is what happened last year. I hope. So that's the way we are going ahead, and of course we have a repository of about 10,000 titles of our own. Plus, apart from that, we are also helping them wherever they have a requirement. We are able to source from the industry and provide to them.
So where do you see this practice leading in next 3 years' time?
Very difficult to put a number, to be honest, but we probably would outdo what we are planning for this year, and hopefully we're trying to build it up to at least 100 crore business year.
Got it. And what kind of margins are there compared to ensure that this must be slightly higher margin compared to our regular business? You mentioned something in the previous call, so if you can elaborate from this year's experience as well.
Unfortunately, we'll not be able to give a margin on this. We can take that offline, but this is a...
No, I think one way to look at it is that our wherever in-house being used, the margin will be higher than outside the company contract.
Yeah. So wherever our content is going, it's almost 90% margin for us.
Got it. And my next question is about the cash position. So since we are debt-free, as you mentioned, so what kind of net cash position we'll have next year compared to this year? I think we are close to 100 CR now. So next year, what kind of cash position we are anticipating?
Considering we have a capex of about 20 crores coming up, I would say we should be around at 130, 135.
Okay. So we have declared a dividend of rupees 4. If not wrong, this is a similar amount as last year. Since we have a very strong cash flows and we continue to be debt-free, so why do we not consider buyback or higher dividend payouts or both? You hinted something on the buyback in your initial commentary, so if you can consider that as well.
Yeah, we are considering that. Unfortunately, because of the war situation, we are slightly taken. We're waiting for things to settle down because it's best to have cash in books for this uncertain period. Once this gets over, then of course we'll definitely consider. Because this year we're not sure what kind of paper prices, what consumer prices are going to be. So that's one issue. And coming back to one earlier question that you had around growth, if you see, most of our growth last year was driven by volume growth. Pricing growth was very limited. So when you see, we did expand our market share in the business. Volume growth was very good last year as compared to pricing was still muted. So just to answer that question, by 10 to 15 is looking good because, again, mostly driven by volume growth.
Oh, fantastic. And how is the paper price now? Just final question. How it is shaping up? Do you see any increase in the paper prices now, considering the war situation and some difficulties in the raw material for the paper companies?
Yeah. Paper prices definitely we expect to grow by 10 to 15% this year, at least. Maybe more also. But right now we are in negotiation stage with all the paper mills, and we have not finalized our rates for this year. But we expect a 10 to 15% increase, which surely be there not only in paper, but on chemicals, glue, the plates, and even with the new labor code coming in, the prices for the labor, the cost for the labor will increase. So all the raw materials and all the, I would say, all the processes and everywhere the prices will surely increase.
So we'll have some hike because last year we have not taken, so we'll take some hike in the prices also.
Of course, we'll take some price hike in the way we increase our prices, but we also cannot take too much of hike. We expect that the price hike would be in the range of 6 to 8%. That's the only maximum we can take. We can't take beyond that because then there's a pushback from the customers from the market. So seeing that, we can only expect to grow at that level. So we are still in the process of finalizing our internal budgets and all, where we will be able to see where we can cut costs without affecting sales and where we can improve our margins. And we are, I think, right now in that stage. But next month or so, we'll be able to finalize all those things.
Got it. Okay. Thank you so much for answering my questions. Wishing you best.
Thank you. Thank you.
The next question comes from the line of Praneeth with SJ Investments. Please go ahead.
Questions. So in terms of licensing, what percentage of our IP is already licensed versus not licensed today?
What percentage is very difficult to say because to each client it's a different set that is going. So how do I answer that question to you? I would say on an average about 30 to 40% is licensed as on today.
Got it, sir. So is it fair to assume like the cumulative revenues we've done so far, that's what it's left going forward also, right? Because our IP is limited and I understand we're doing acquisitions, but do you think to get to the 100 crore mark, either we have to acquire more IP or we need to sell the same information to different customers? So do you think the other customers will also offtake the same information which is already sold to the rest of them because it's already available in the market, at least on the web?
So everybody's building their own LLM and they would need licenses to train their LLMs. So it's not that if it's available in the market, they can also use it. It's specifically to that company. So I would say more clients are required, I would say. And we are in the process of doing that.
So Praneeth, let me just give you an example. So for example, if we have, let's say, a book around mathematics, okay? So if it's a mathematics book, then the same will be required by whichever client wants to build an LLM, right? So if we have licensed it, or if we have given it to one client, it doesn't mean we cannot give to 9 others. Because, for example, primary class mathematics remains the same, right? So to that extent, it's not as if it's being used by one, it cannot be used by other clients.
Understood, sir. So got it. So, but do you see the pricing by any chance reducing for the same information we gave in the past? Because I'm pretty sure the business model is getting caught up in the market. Like similar publishers with similar IP must be also coming into the market. Do you see any price erosion in that terms compared to the past?
Pricing is completely very confusing in this segment, to be honest. It is varying so much from one client to the other. It is difficult to put a specific finger on it, but I would say it's more about the period of the license that they are taking and the segment of the books that they are taking, what language they are taking it in. So pricing is very dynamic across. Yes, we've seen a slight correction in that, but it's not gone down substantially as yet.
Got it, sir. But in terms of the overall norm set for content, these AI players, are they doing similar with other types of content also? Is it only with education that they're doing these licenses and we are able to capitalize on this opportunity? Because everything seems to be still a lot on the fence in terms of other licensing agreements also. But I was just wondering, how are we able to capitalize on it so efficiently while other people are still confused on how to license and all of those things?
Well, I think it's happening across. It's happening across medical, legal. I'm sure a lot of people are working around that. I'm not privy to most of it, but definitely aware that a lot of work is going on in the medical segment, in financial segment. So, I mean, there are thousands of companies working on various models around. So it's not only education.
Got it, sir. But I already mentioned that most of it is usually either one time, at least it's split between 1 time and 2 years or at max at this point of time. But do you think these licenses will be continuously required, or after training there'll not be any requirement? So I'm just wondering if this can be an annuity income of sorts. Let's say you just lease the asset out and you can get to annuity income for the next 4 years. Can that be possible, or once the information is trained, it's unlikely they will come back to us to buy the same information back?
So once they've used it, they continue. See, if they've taken a perpetual license, then of course they can continue to use it for perpetuity. But if they've taken a term license, they'll need to continue to renew the licenses. Otherwise, see, it's very difficult taking out the information from the model, no, once you fed it into the model.
Got it, sir. So is it a fair understanding that once the information is given out, even for a year or whatever percentage of the information is given out, it's likely that that's the end of the revenue with the client, unless it's new information.
Yes. So far there has been renewals or whatever we've given on term basis. There's been no renewals that have not fallen on the side. So far it is, I would say, 100% customer retention. There have been renewals wherever they've been given the content on the renewal basis.
So, sir, out of the 5 clients, how many are the perpetual ones versus how many are, let's say, recurring ones, out of the probably 5 customers we gave to?
3 were perpetual, 2 were the period licenses. But the 2 that were the period licenses account for most of the revenues.
So most of this year's revenues are most of the period licenses, right?
The period licenses are the larger revenues that came to us.
Got it, sir. And one more thing, with regards to, let's say, this year's margin improvement, most of it seemed to have been coming from the digital revenues growth. Even like it was approximately like 10 crores we grew, 10 crores in terms of EBITDA we grew, and approximately our EBITDA margin that would have generated from the incremental revenue from digital would have contributed to that. So does that mean that our underlying business is still facing some headwinds in terms of pricing and overall the cost progression led to the final customer? Is that fair understanding?
No. So this year, in fact, the margins from the digital business were lower than last year. While the revenue grew by about 10-11 crores, the margins were lower by about 4 crores. So the margins have come from the publishing business, not the incremental margins have come from the publishing business, not from the licensing business.
And the reason for that is the origin of the content.
Last year was completely our content. This year we've sourced content. So that's why the margin profile has shifted.
So let's say if you gave 100% of a license, 100 content, what was the outsourced content versus our content this year?
Last year it was 80% ours, 20% outsourced. This year it's 30% ours, 70% outsourced.
Got it, sir. Just one question in terms of the NCF. So as I understand it, during silver exchange is the time we can actually gain market share and also at the same time increase our prices because the supply of those books is a lot lower. But why were we not able to increase the prices? I understand trade. Why is trade pushing back? Just trying to understand how the market dynamics are at this point of time.
Who's pushing back?
You mentioned that pricing we were not able to increase this year, but usually the pricing increase happens during the silver exchange, right? So I was wondering, is trade pushing back or why are we not able to increase the prices during one of the transitional times is where we can actually get the pricing right?
The pricing is again a function of multiple participants in the market, and then again, these are education books that we are providing. We continue to remain in the mode that books have to be affordable to students. So it's not that we can take something that is reasonable. We do. Beyond that, of course, we are also not comfortable with.
Understood, sir. So from perspective and our growth strategy for the, let's say, the new international syllabus business. So where are we at today and where do we think we can go in the, let's say, next 3 years? And how are we exactly working towards this in terms of management bandwidth and everything? Because we already have a lot of brands in the country. So how are we able to concentrate there also?
So we don't have a brand currently in India which functions in the international curriculum space. CPD, which we acquired also does not have any presence in India at the moment. We would have to market this content to the Indian schools. It has a presence in South Asia, which we are trying to further enhance through marketing, and so that's the plan. It has huge potential because again, that's about 4,000 or 5,000 schools that we can target, but taking slow steps, and we'll probably get there in 3-4 years' time.
So, sir, in this, especially international business, let's say, what is the value of a school if we onboard that school, international syllabus business, and how many schools are we already at with the CPD business today?
CPD business right now is only mainly concentrated in Singapore and some bit of in Malaysia and Indonesia. And in Singapore, there are around 482 schools. Those are all mostly government schools, and the government prescribes the ICSE curriculum in Singapore. And we are present in a lot of schools there, more than 200 schools we already present there. But CPD was mainly concentrated in that kind of a market. So we want to grow in now not only in the Southeast Asian market, we want to grow in the Indian subcontinent also, and we are bringing those books to India and the neighboring countries of India like Sri Lanka, Nepal, Bhutan, Burma, and even taking them to Middle Eastern markets when the situation improves. And it will take us, I would say, 1 or 2 years to at least establish this business, because these businesses take time and they don't happen overnight. And we are trying to build a team around it. We're trying to create more content, even localize the content if need be, and doing all those necessary steps. It's just only 4-5 months back we acquired that company. So it's a very short period of time right now. We're also understanding its processes, its products, its systems. So maybe we will be able to give you a clearer picture by, I would say, next year to what is happening in that company.
So right now, all the sales of CPVs are in Singapore and Malaysia. There are no India sales
as of now.
Understood. But what are the full year revenues for that particular business, sir?
Sorry?
The full year
revenue
revenues and profitability.
Last year revenue was, I don't know, how much was it? $500,000 US or something. Sing dollar.
It was around, I think around, let's say, 5 to 6 crores of revenue.
Indian rupees.
And that was December year ending.
Understood. Was it a profitable business or was it break even?
It was profitable for 2 years, yes. Last year was not because, of course, this whole transaction was happening and, of course, the earlier promoter was losing focus, but it'll make money this year.
Got it, sir. So, what kind of investments will we need to put in? Because building a team and also doing marketing is an expensive endeavor. So what kind of capital outlay do we see for this particular division that we see in the next 2 to 3 years, especially when we're establishing a presence across different countries?
It doesn't require a similar level of team as we require in the domestic business. It is only, I think, a marketing team of 4 or 5 people are required. It's not a very big team. It's not a very huge team. In Singapore, we have only a small team of 6 people. So very small team. We may be going to expand that from 6 people to maybe 8 or 10 people, but not more than that. And in India, we will have 4 or 5 people plus 1 or 2 more people in the publishing side. So the total team would be like 10, 15 people. It's not going to be a very large team. So we don't envisage a very huge capital investments in terms of team or marketing. And all marketing also will be done locally. So we have already network and distribution network and marketing things available. So we are not going to spend too much of money. Maybe a small capital investment in next 2 to 3 years of maybe 5-7 crore rupees. Nothing large, nothing major.
Understood, sir. And the 20 crores we had in mind for spending during this year, what was that mostly going into? Was it mostly content or something else?
That's mainly capital expenditure towards we're building a new printing plant, state of the art near Delhi, and for that we require to invest money there.
Understood. So right now, still most of our prints, what percentage of our printing is in-sourced versus outsourced?
Almost, I would say 85%, 80 to 85% is done in-house, and 15 to 20% is outsourced.
So we'll probably in-source that, and for the incremental capacity, this new plant is for, right?
Right now, the plant that we have currently has less space, and we want to have more space and more workable area, and maybe we'll need to add some new machines because in today's time, digital printing machine is coming out and people are investing there, and we are also planning to invest in that region also. So we need bigger spaces and bigger infrastructure, and that's why we're investing money there.
Will this contribute any margin improvements, sir, or is it just going to sustain our margins?
Initially, of course.
I think first year, second year, it will be difficult to say. But I would say after that, when the plant is fully integrated and fully operational, then we will come to know the exact details of the incremental margins. But definitely, it will help us increase the volume. It will help us improve our efficiency, quality, delivery, and also margins also, ultimately.
Also, working capital will be more efficient once we have more POD machines, digital machines.
Yeah, that will also help eventually.
Cater to smaller print runs, and then, of course, the inventory holding will be lower.
Yeah, sure.
Thank you. The next question comes from the line of Keshav Garg with Counter Cyclical PMS. Please go ahead.
Sir, my question is on the share buyback. Now, if we see the company came out with the IPO 9 years back at 670 rupees, and now the stock price is roughly 1/4 of that, and our enterprise value is like 500 crores, and our EBITDA is like 130 crores. So basically, the whole business is trading at less than 4 times EBITDA. So why I'm not able to understand that what is by not doing buyback, basically the management is the apprehension in the shareholders' mind is that this is a dying business. That is why even at less than 4 times EBITDA, this business is not worth doing a share buyback. So it's better to go out and buy some other company and maybe 10, 15 times EBITDA rather than doing own share buyback. So that is the apprehension that comes in the mind of shareholders when you don't do a share buyback at these valuations and with this kind of net cash and balance sheet.
I don't know. Atul, you want to answer that?
Yeah, so, buyback is something that is being considered, and, the board usually considers matters like these. We give this feedback, and we will see, in the coming times when, something like this happens.
Yeah, having said that, please also look at the performance of the other buybacks in the same industry where people have done it, if it has done anything to the share price. So I'm not saying that we will not do it, but if somebody is saying that share buyback will have something to do with the share price, I don't know. Perception of the industry, of course, may be whatever it is. I think we are still a very strong, financially strong and stable industry which has got less impact of the global war as compared to the others. And we continue to, the K-8 segment for schools will continue to be there. There is no way around that. Kids outside India also have come back to books, whether it is Sweden, whether it's all the other countries which had gone digital, they are back to books. So K-8 segment is not going anywhere and we will continue to be there.
Sir, now the thing is that the other players who has done regular buyback, they are trading at like 10, 11 times EBITDA, whereas we are trading at 4 times EBITDA in the same business. So it does make a difference. That is the first thing. And the second related question is that the other player also, their publishing revenue is also flat since FY19. And just like ours is flat since FY18. So I'm not able to understand that what exactly happened to this industry that after FY18, FY19, the industry doesn't seem to be growing. At least the big players doesn't seem to be growing. So what is the reason behind that?
My friend, the big reason was Corona. I think we all know about it. We are all affected. And education industry was one of the most highly affected industries in that period of time. Corona had an impact of 2.5 years for the whole industry. And the education was very highly affected. And we were able to keep afloat and manage our companies. That was a big challenge. So we were looking at that mostly. And after the Corona got over, we got back on track and got our revenues where we started from, and we are back again there at that levels. And we are focusing more on improving our working capital and cash flows, and that's what our focus is, and that's what we're doing.
Sir, and what is the steady state net working capital days that we should expect in this business forward?
Sorry?
So the working capital days obviously depends from quarter to quarter. So if you look at the Q4 numbers, we can do some improvement in our receivable days and inventory days as of from whatever has been reported in this quarter. That is, the maximum amount of guidance that probably we can give. But most of the improvement, if you see the 5-year performance or 7-year performance of receivable days and inventory days, we are probably down 50 to 70% in terms of where we were 7 years ago or 5 years ago. So these levels, you can probably improve them by 10% or 15% odd, but yeah, I think that will be probably a stabler level for the Q4 at least. And as if you have tracked our company's quarterly performance, every quarter it will be different. So right now I'm only giving an answer for Q4.
Understood. And so lastly, what is our current market share and what was it, let's say, 9 years back?
In terms of?
In terms of market share in the segments that we are there, any approximate number?
There's no exact number, very difficult to calculate because there are many, many players and it's a very unorganized segment. Very difficult to say, but we anticipate our market share of the school business to
to be in the range of 10 to 15% of the private school publishing market, approximately. That is also, very, I would say, cannot be an exact figure, but that's a figure that we feel is, maybe closer to the market numbers, 10 to 15%.
Sir, and how has this changed over the past decade?
It's not changed much.
Because the market, more players have come in, plus what I said earlier, the corona impact was a major, and companies are trying to stabilize after that. And the market has grown, but not to the extent that we expected, that the huge market opportunity is there. But we have grown the market share, but I would not say a very huge number.
Just to add to that, pre-COVID, higher education constituted almost 20% of our market. Currently, it's about 8%. So the degrowth has happened in the higher education segment. The school segment continues to still grow.
Yeah.
So we are higher by about 20 to 25% in the school segment. It is the higher education that has degrown over the last 8 years.
So what is ailing the higher education pie of our business?
Students are not buying books.
And it's not just our business, the whole higher education segment, the college segment, students, we see, there is an increase in piracy, there is decrease in the number of books which are purchased by students. So this is a segment and an industry-wide phenomena for higher education segment.
Understood, sir. Thank you very much.
Thank you. The next question comes from the line of Riya Mehta with Equitas Small Finance Bank. Please go ahead.
Hi, this is Riya from Equitas Investments. So my first question is in terms of when we, for FY27, we have guided a range for EBITDA. Does this take into consideration the higher cost which we are anticipating for paper and other raw materials, etc.?
Yeah. Yes, it does.
So, despite the cost pressure, we are confident of at least minimum 17% EBITDA margin.
Yeah, we'll be able to pass on some of it, and the rest we'll make up from our internal efficiencies.
Okay. My second question is in terms of where do we generally procure paper from? Is it domestic mills or is it imported paper also? And what kind of inventory do you have for paper?
So we have a mix of acquiring paper from both international paper mills and domestic mills. The ratio depends on year to year. It can be almost 50-50 in most years, or 60-40. That is the range that we see. But now the dollar pricing has actually increased a lot in the last 1 year, and the paper prices have also increased in terms of the normal paper prices, plus the logistics costs also increased. So we have to see this year how much paper can we import. So we don't have right now a figure for that. We are still negotiating with our suppliers. And what was the second question? Sorry.
So I remember. Yeah, we have given it in our investor presentation. I think 29 to 30 crores is the finishing raw paper inventory at the year end. There is a chart about this in our investor presentation. You can just have a look at it, but I think it's around 29 crores.
Let me find out. Where is it?
It's on page number 12 of our investor presentation.
Paper, page number 12. Total raw material is around 29 crores.
Yeah, I have seen that amount. I just wanted to know how many months of inventory does that constitute?
29 crores of paper inventory would be, in the peak season, it will be inventory of less than a month in the peak season, and in the non-peak seasons, it might be inventory for 3 months.
Thank you. The next question comes from the line of Murtaza with Pinpoint X Capital. Please go ahead.
Hi, sir. Good afternoon. Am I audible?
Yeah.
Yeah. Thank you for the opportunity. Please excuse me if this question has been taken. I just wanted to understand, despite having a 6% GST hike, we had maintained our gross margin. So, was the full impact of this felt in FY26, or has there been any partial carry forward impact into FY27? And how much have been how much have we been able to pass it on?
So the GST impact came in November. Of course, there is no way we could pass it on because all our pricing happens by September. Our catalogs go to the market, right? So whatever we had to do, we had to manage internally. Of course, we had already sourced about 50 to 60% of our inventory last year. So the impact was only on 40% of the paper purchases that happened post November. So some impact will be factored, but that has been already factored into our numbers.
Okay, sir. And so regarding, my second question is regarding NCF coming in FY27 with the new books, better realization, there should, ideally, the data should be a little bit higher, and we've been guided at slightly lower, 17 to 19%, where I think it should be a bit higher. So I just wanted to understand what sort of specific cost investment are we looking at? Is it CPD or is it sales team expansion or some price hike that we are taking in, or some content development cost that's coming in? I just wanted to understand this better.
Murtaza, your voice is not clear. Your voice is echoing a lot. We could not understand your question. It will be great if you can, either speak loudly or maybe if you are on speakerphone, go to a direct line and speak slowly because we could not understand what you were saying. You have to repeat your question.
Is this better?
Yeah.
Yeah. Sir, my question was with engine coming in FY27. Ideally, better realizations are expected. So I just wanted to understand the EBITDA guidance that we have given, the EBITDA margin guidance that has been given, that is 17 to 19%. I feel it should be a little bit higher. So I just wanted to understand why exactly it isn't. That is it, are we taking in some cost investments such as CPD, or is it some sales team expansion or content development, or some price hike that we're expecting in? Just wanted to understand a bit better.
So we specified that in our call also. See, the 17 to 19% is also because the price of paper, price of consumables, printing, all the direct costs associated with the books will increase. And of course, with the inflation increasing because of diesel, petrol, that will have also an impact on the employee costs. So we are that's why we've given a 1% lower range as compared to last year.
Thank you. The next question comes from the line of Ronak Khetan with Ishanika Securities. Please go ahead.
Thank you for the opportunity. I hope I'm audible.
Yes, Ronak, please go ahead.
Yeah. So with respect to the digital revenues, I wanted to understand if this forms part of the statutory licensing revenues as per the government, because under statutory licensing, the royalties are already predetermined and it's fixed. So there is no negotiation which is involved because the rights or the title can be easily accessible. So do we form a part of the statutory licensing revenues, or this is something else?
No, this is not statutory license.
So there is a negotiation power which we hold.
Yes.
When we are...
Whether we hold it or not is to completely, it depends on the client relationship also.
Okay, so
this is not nothing to do with, there's no statutory thing here, but there are negotiations that do happen.
Okay, so are you in a position to reveal some of your clients, or that is not possible?
There are NDAs around that, we cannot reveal the names.
All right. So when you're looking into procuring outsider content and essentially process it and forward it to such clients, I wanted to understand what is the value addition that is present here, wherein the client is not directly procuring it from whom you are procuring.
Multiple things. The client cannot open an account with multiple people. Plus,
so also it's a matter of relationships that we have, right? So if let's say there is a big US company and they want to procure Tamil books, for example, they might not be in the best place to reach out to every publisher in that space. And we might have a better relationship where we can source it for them.
See, also the quantum of content that is available with multiple people may be too small to get into small contracts. So we act as like one-stop service providers for that.
All right. So when you're talking about M&A, does it also include such content acquisition, or is it mostly directed towards acquiring other smaller publishing houses?
So that includes licensing also. We've done one last year.
All right.
Thank you. The next question comes from the line of Manpreet Arora with Arora Wealth Advisors. Please go ahead.
Thank you. Am I audible, sir?
Yes.
Yeah. So, sir, first, would just like to understand this perpetual license versus, term-based licenses. Now, isn't it in our favor to go for more term-based licenses, which will allow us to have annuity income rather than go for perpetual licenses? And, given the industry structure, we have the content with us. Is the bargaining power with us in terms of defining what kind of contracts we get into, or is it the buyer who has the more power in terms of the time? If you can help understand how this whole thing is.
It's a mix of both. Yeah. Sometimes we have it, sometimes the buyer has it. Depends upon the size of the company we are in discussion with.
And also the content being requested for.
Sorry, can you please say that again?
So, see, of course, we prefer a period license. That works for us. But where the buyer is adamant on a perpetual license, of course, he'll pay higher and take it.
Okay. So perpetual means, there's no end date to it. It is for the next 100 years. Is that something?
No.
It is.
See, content also has a life, no? We continue to revise every 2-3 years, so content also has a life. And it's a non-exclusive license that goes, so it's not that I cannot use it again.
All right. So my next question is, we've been speaking to principals of some private schools to understand the buying decisions of schools. So what we have been hearing is, principals of the big private schools engage with multiple publishers, and, for 2-3 years they will buy from one publisher, and then for fresh content, then they'll move on to another publisher. So in this, the kind of loyalty to a publisher or a brand, it appears to us by speaking to some of these principals that, they stay with the publisher for 2-3 years and then move on to another publisher for fresh content. So is that observation true for the universe of schools we serve also, where they stay with us for a couple of years, then move on to any publishers and come back to us? Is that how the whole industry operates?
Ultimately, my friend, it's all about how your good relationship with that particular school or customer is, or how good your service quality is, how good your product quality is. It all matters. It doesn't only matter if the school has to shift or the school never will not shift. It's not ever black and white. It's always in the gray. But you have to make sure that you give good customer service, good quality product, and maintain a good relationship with your customers, and then we'll have a long-term business relationship with you. So it's all about the relationship management. So that we have been doing for last more than 8 decades, almost 9 decades now. And we have seen that most of the customers that we deal in the school business, we retain them. I would say we have a retention rate of more than 70% in the school business, and that we continue to retain, and we continue to add more customers.
Thank you.
There have been some schools that have been using it for decades now.
Yeah.
So it's not that schools have to shift every 3 years. There is no norm as such. Every school has got its own this thing. Again, it is also a matter of what subject.
And also innovate content also, na? We keep on innovating. It's not the content that we have created 10 years back is the same content that we are selling today. We keep on innovating, keep on upgrading, keep on changing as per the market requirement, as per the customer requirement, and we can also, depending on customer to customer, even customize the content. If the school wants us to customize the content for them, it's a large school chain, then we can customize for them also.
Thank you. The next question comes from the line of Sanchita Sood with Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. My question was related to the content licensing division. So this 400 million plus revenue that we've targeted for FY27, how much of this would come from third parties and how much would be our own?
Very difficult to tell you right now, but my sense is this year should be a large portion should be from in-house. I would say 60-40. But then that's a guess at this moment, because it's very difficult to say what content a customer might need at what point of time. We are in discussion with a couple of customers. So far, I think so it's more our own content that is going. But again, when we come to more clients, then we'll get to know.
Sanchita, and also this is looking as of the pipeline as of today. Okay, maybe 3 months down the line, ratios and numbers can be different as well.
Okay. And so this 400 million figure, is this based on the per user basis? Is that how it's been estimated? Because with more and more people using AI, there might be a high chance that this number might increase, right? So would this be a conservative figure?
So this is not per user basis. This is per SKU, per title that we give license for.
Okay, I see. All right, that's all from my end. Thank you.
The next question comes from the line of Moksh Ranka with Aurum Capital. Please go ahead.
Sir, we are estimating our AI dataset revenue as 40 crores and our 50 to 60% is from in-house content approximately. And in-house content, almost everything close to the bottom line. Don't you think our margin guidance of 17 to 19% is quite conservative? Because we are increasing our mix of AI data set revenue, which is even third party would be higher margin than a publishing business.
See, that's why it's 17 to 19%, na. So last year we hit 18%. We could go to 19%. So it's a band that we've given. Again, depending on what we finally end up with.
Also, there is another thing to note here. See, I mean, currently you are seeing fuel price increases, right? So we are thinking in May. If let's say by August our costs are different, by different ratios, then obviously we will end up at a higher margin band.
Provide me some color as to like what is stopping us from making this a 100 crore business, because I think it's quite asset light and the scalability should be quite high in this. What is the key impediment for us stopping us from like going into 100 crore business like AI data set?
There's nothing stopping us. We are working towards that, yeah.
Okay, because I think we did 19 crore in FY20.
See, again, it depends upon the client's budgets. No? Clients also have budgets on how much they can spend on content. Everybody's got their own budgets. That is the constraint that they have.
Okay.
See, this is not like a traditional business where you can put feet on the street. The more number of people you have, the more number of sales you do. You have to understand that this is a B2B kind of a business, and every customer will have a different mindset with regards to the spending that they want to do.
Okay, and do you have any idea about the market size of this business and maybe like our market share, like anything, if you have some color regarding that?
No, we would not have any color.
Okay.
See, we don't have view into what the other companies, what our customers are spending on their other, content acquisitions.
See, everybody's got NDA. Nobody is discussing all this out in the market, to be honest. And Since we are a listed company, we are still discussing about this. But to be honest, the other publishers not even talking about it. So very difficult to get color on what is being sourced. Even our clients are not saying how much they are taking from X, Y, or Z. Right?
Okay. Okay. Got it. Thanks for all your clarification.
The next question comes from the line of Praneeth with SJ Investments. Please go ahead.
Hi, sir. Thank you for the follow-up. Just one question regarding our EBITDA margins. You mentioned you guided for the next year around 18 to 19. Is it possible for us to go back to, let's say, 2015 levels or 2017 levels or 25? I understand the mix of higher education was higher and all of that, but is there a future where we can get back to the 25% margin business?
I would rather see if you look back at those numbers, please also look at the cash flows that came with that. See, we are working towards an efficient working capital and a cash generating business, right? To go to the 25%, try to push revenue growth, incremental growth may give you EBITDA, it will not give you cash. So look at those numbers. At 800 crores, we were doing 38 crores of cash flow from operations. This year at 800, we've done 75 crores. There is no comparison between those times. I mean, what would you prefer as a business? Would you prefer cash coming in 75 crores, or you would prefer that extra 3-4% in margins which do not translate into cash? At this point of time, whatever profits we are earning is coming to us in cash. It's not lying anywhere in terms of inventory or receivables. So our focus is to generate cash in this business so that we can continue to do some M&A so that or buybacks or dividends so that every stakeholder gets benefited from that. At that point of time, with high growth, we are not getting working capital efficient. So we do not want to get into that mode. Yes, of course, if there are chances of improving the EBITDA through more efficiency, definitely we will try. But it's not going to be an easy thing to do.
Understood, sir. So this is sustainable for us to generate consistent cash and grow consistently. This is it's like the sustainable EBITDA margin, right?
We have to have a right mix. We are happy generating cash and it's lying in our books rather than borrowing from banks to generate that kind of revenue, which again makes us capital inefficient.
Got it, sir. So, and one question regarding our entities. So, as I understand that we have many brands and different entities that we acquired over the years. Is there any plan of consolidating those entities into a standalone business, or do you want to keep them as the subsidiaries itself?
No, they'll continue as separate brands. They can't, otherwise we'll end up killing our own business because three different people have to go to schools, 3 different adoptions have to happen, otherwise we'll lose market share. So we cannot consolidate.
The consolidation, the idea of acquiring these companies was, you have to understand the basic concept of it. It was like you're acquiring the school bag share of each child. So every child normally in India, when he goes to a school, let's say a child goes to a 6th grade class in a school, he will carry 10 to 12 books in his bag. So when we started acquiring, maybe we had a bag share of maybe 1 book per child in that. Let's say 1 subject, as example as maths. But when we keep on acquiring companies, we acquired 1 more company. So we got 1 more book in his bag. We acquired 1 more book in his bag. So maybe today that child is carrying 3 or 4 books in his bag rather than having 1 book in his bag. So it was more of acquiring the school bag share, keeping the companies and the brands and the teams and the sales team on the ground level separate. And we never wanted to consolidate them. If I would consolidate them, then we will still be remaining on 1 book only, because when you go to a school as a 1 salesperson, the school does not give you all the books to that person because they have to also entertain other salespeople. So basically, we had that's why we had separate sales team and we have a separate offices for them and everything, and they work as a completely separate entities, and that's why we have a better market share now what we previously used to have.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the senior management of S. Chand for the closing remarks.
Thank you. It was quite interesting and we had a lot of questions this time and we are happy to answer all of them. If any questions are left, you can email us and we can be happy to answer them. And have a great day and take care of yourselves. A good afternoon once again. Thank you.
Thank you.
Thank you, sir. Ladies and gentlemen, on behalf of S. Chand Group, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.